Please give a big round of applause to Mr. Kelvin Lam, Head of Retail Distribution Southeast Asia from Allianz Global Investors or AIG. Mr. Christopher Wong, Client Portfolio Strategist, Southeast Asia, Fidelity International. And Mr. Yash Patodia, Senior Managing Director, Partner and Global Industry Analyst, Wellington Management. So, three gentlemen, the three musketeers, joining me in this very session in a hot topic that I believe that all of us are interested to learn more, the tech sector. The tech sector has performed very well in the past year, especially on AI-related themes, and a lot of investors have missed out on the long leg bull rally because we expected a recession, but that did not happen, and it was driven by tech stocks. So do you think the momentum continues and the rally will be sustainable in the year 2024? I'd like to ask the three of you to share your views, beginning with AGI. Mr. Kelvin.
All right, sure. Sawasdee krap. For us, in terms of Allianz Global Investors, I think that, ChatGPT, right, has definitely experienced an iPhone moment when it comes to artificial intelligence. Due to the fact that ChatGPT has now initiated a lot of demand for generative AI technology, that has actually created a structural opportunity set for AI. I think just recently we have actually seen companies like Baidu, Google, Meta, trying to create their own generative AI apps. And this does not happen over weeks or months. It takes many years, data sets, remodeling, and hence, this structural growth backing AI up is not something that is going to be sizzling overnight. In addition, we have also seen collaboration between Microsoft and OpenAI, which is the creator of ChatGPT. And you can actually see that this collaboration is also expected to create new revenue stream, right, for Microsoft. And Microsoft has actually mentioned that they expect their AI, which is like the co-pilot that they are actually formulating, is expected to generate new revenues up to US 10 billions. And this is actually the most exciting franchise they are developing historically based on revenue projections. So to answer your question, is AI going to sizzle overnight, and is this rally going to sustain? I believe so.
Fidelity, Mr. Christopher.
Sure. Good morning, everyone. Thanks for having us here today. So I'm going to answer this in just a couple of parts, and I'll also reiterate a little bit what the first panel kind of discussed earlier. So on the rally, actually, if you look at it, the rally has only, if you use the trough in October 2022 as the benchmark, it's been about 16 months old. If you look at the prior rally through to the COVID drawdown, it was about 10 years old. So I think what is a bit more surprising is the trough to date, right? The rally since it's about 80%. But then if you put it in perspective, that comes after the 35% drawdown during the interest rate hike cycle of 2022. So from that perspective, really, the recovery you've seen is a little bit less dramatic, right? When I put it in perspective, it came down quickly and is recovered and made a little bit new high thereafter. And the second level I'll delve into is what the first panel kind of touched on as well, what has driven the rally, right? So last year, 2023, 60% of S&P's returns, for example, driven by 7 stocks. 40% of the NASDAQ by that same 7 stocks, right? This year, it's been a bit more narrow. 4 stocks has really driven the rally year to date in multiple indices. So if I look at it across performance, across the 7 stocks versus many of the tech stocks from trough to date, the difference with returns really has been about 50 to 70%. In other words, these 7 stock stories have outperformed 50 to 70%. And valuations have also expanded quite some bit more in these names than the rest of the market. So my first point here is really you need to be discerning. The mega caps, the Magnificent Seven as they call them, have rallied a little bit more. Earnings expectations have gone quite high. Just need to be very careful here. Beyond that, in some of the other parts of the market, mid caps, etc., we are still finding good opportunities. So that's one part, right? The second part of really stock returns is earnings. So from our analyst perspective, we're expecting about 20+ % year-on-year growth in earnings in the tech sector, and that's the fastest or largest in the world. So that will also underpin growth this year. But the whole point here is really to sift beyond the very well-held mega cap, Magnificent Seven, whatever you call it, go beneath the hood. There are other winners benefiting from some of the trends that Kevin mentioned, even cyclical ones, right? In tech space, there are some cyclical developments happening.
Mr. Yash, do you think the space is too crowded now at this point?
Yeah, thank you. And thank you for having me. Good morning, everyone. I think you have to think about technology cycles in multi-years. So think of the last big cycle that we remember, which is smartphones. That is a cycle that lasted for, still lasting 15 years. The apps that you're using, TikTok, Instagram, they didn't exist 15 years ago. We are 1.5 years through in this new AI cycle. We're still very, very early. We're at the stage where you're building the infrastructure for it. The applications are yet to come because as of now, most of you haven't really experienced how it's really changed your life. But one thing I'm confident of is in 3 years from now, you will all have changed the way you're actually working. So I would say that think about things in longer term cycles. That has always been the way to invest in technology. The second point I'd make is it's not just AI. There are many different multi-year themes in technology today. There's automation, there's Internet of Things, there's fintech, etc. So there are many different tailwinds which are multi-year tailwinds that are going to help tech companies. And if you believe that technology is going to become more important in your lives in a few years from now, then I think you have to focus on sort of that long-term value creation opportunity. And finally, I'll echo a similar point, which is that a lot of the headlines today go to the Magnificent Seven. It's funny how there's an acronym after whatever is doing well, but it used to be FANG stocks, Magnificent Seven now. But there are a lot of names that are exposed to similar trends, which are actually under the radar. A lot of them are actually here in Asia. So that is one of the areas that we are seeing a lot of opportunity. And at least when we think of it on a multi-year basis, we think that there is still a lot of opportunity that hasn't been realized.
I see. So AI will certainly be a big trend to drive growth and potentially be a transformative one. So let us take a little bit of time to dig into some of the key tech themes and sectors to watch out for this year, especially the ones that you find opportunities in or the emerging technologies to consider. Now we hear generative AI, we hear on cloud service, but to elaborate, could you tell us more about this?
Yeah, I think, due to this structural growth, right, there are a lot of efforts, investments that needs to be done to make the evolution of AI to ensure that it will happen, right? So I think one of the biggest trend that we do observe is clearly AI infrastructure, right? We need to build the data centers, the cloud, the connectivities, and it takes millions of dollars, right? And why is NVIDIA making so much money? The chips are out of stock, right? Basically, they are sold out for the rest of the year. And that reason is because there is so much demand, right? So AI infrastructure is definitely a trend that we do see multiple years of investments. Other trends that's a bit more light-hearted would be the AI-enabled industries. So you can actually see that artificial intelligence is not just on technology. It could be other sectors, healthcare, automobiles, financials, so on and so forth, right? And on the lighter side of things, in the consumer electronics exhibition that happened in the US early this year, which is noted as the world's largest consumer electronics, there are new and more immediate things that are going to be delivered. So we have actually seen NVIDIA also coming out with a killer app that helps gamers, right, play with artificial players, where you can actually talk to an AI bot that can reply to you and play with you in an app. This is revolutionary. We have also seen Mercedes coming out with new virtual assistants, driving tools. So maybe you can imagine Tony Stark in a car, right? And lastly, we've also seen LG and Samsung coming out with new devices as a human Autobots to be made available in your home to remind you to take your medicine and to actually tell you that it is time to sleep, so on and so forth. So we do see that these trends are reshaping. And lastly, you have not come to our booth outside, please take some time to come in. We have this time machine booth, right? That is very similar to how the latest Sora system, where you type text to wording to create a video. So we are not so advanced. So we take a picture of you and we put it into a video for you, right? So that it can actually feel how AI has actually evolved currently.
Christopher, what are your views?
Yeah, there are actually a lot of trends that are happening, and I think I would probably speak for 20 minutes if we went through. But I think the most obvious one is AI, and I totally agree with what Kevin said, right? The opportunity is huge. But I'll just caveat it a little bit to say certain parts of the tech infrastructure have priced in a quite blue sky scenario. So when kind of getting exposure to AI, we scour through the value chain. We are finding good opportunities that have not fully priced in this structural trend, and that's how we're expressing our view in this kind of structural trend. Beyond that, I think another trend we're spotting is reshoring. So I think the first panel touched on it quite a lot. But when you reshore, other than building out infrastructure, as a company, what you need to do, you need to re-automate, right? So this kind of reshoring is happening at a time where your cost per unit labor is a lot higher than when China was in its earlier growing stages. So cobots, robots, robotics, all this will again be in demand. So the hardware side of technology, we see that also as a structural change. One other trend maybe is just general digitization. So in the consumer space, we have seen adoption of digital technology happen quite quickly, right? Our apps, our software. But in the more traditional side of things, let's say in industrials, in energy, a lot of these companies or these sectors are only in their very early stages of adopting technology. And that again to us is a multi-year trend. Now beside these structural ones, we're also finding some short mid-term ones, a little bit more cyclical in nature. So for example, we are seeing demand in PCs, lower-end smartphones, especially in the emerging countries, start to pick up as well. And that for us is quite a unspotted, less discussed area in the tech space. So that's another trend that we are also spotting.
What about the sustainability trends? We hear clean energy, green tech, for example. So should the investors follow the green money?
Maybe I'll start and I see whether my other panelists have other ideas. But technology is an enabler in all sectors now, green technology included. So how we're getting our exposures, for example, are more through software. So there are software companies, for example, out there that are helping a lot of industrial companies provide more green-like solutions. That's one area. Or even in energy, there are companies that are using kind of technology to help other parts of the energy supply chain reduce carbon footprints, reduce carbon capture and the likes. So technology is pretty prevalent, and even in this green space, there are software, etc. names that are helping with this general transition as well.
I see. Now turning to Asia, let's take a look at the technology sector. How is it developing compared to developed countries, and what kind of opportunities you see in Asia for tech?
Yeah, sure. Thank you. So I think most of the audience might be surprised to hear that there are more technology companies that are publicly listed in Asia than Europe and the US combined. So there's just, for someone like me who's looking at companies and meeting companies and trying to understand them, it just gives a much bigger set of companies to go do research on and to find opportunities in, which I find really exciting. Also, one of the unique things about Asia is that companies tend to go public earlier in their life cycle. Whereas, in the US, for example, you have a large private market and a lot of the value accrues to the private market. Companies in Asia go public sooner, so public investors can actually benefit from that value accrual in an early part of the cycle. Then there is digitization, which a co-panelist mentioned. Asia is still early in digitization, so if you think about consumers, the amount of shopping that you do on e-commerce, for example, has probably increased over the last 2 years, and it probably will continue to increase. The food that you order for delivery will probably increase. So the usage of consumer services is still early, and that penetration we expect to continue to go up. That's exacerbated on the enterprise side. The software that companies use within Asia is actually still very, very early. It's a fraction of what is used in the West. So these are some areas where we think there's long-term opportunity in. One of the areas that we're most excited about today is sort of this enabler space or the semiconductor supply chain. And just to go back in time a little, about 30 years ago or so, companies in the West decided when they wanted to manufacture chips, they wanted to outsource that to Asia because it was cheaper. But what's unique about semiconductors is that the rate of progress is so high and it gets so much more complicated over time. You know, some management teams talk about it as being the pinnacle of human achievement. It's basically rocket science, what's going on in the semiconductor world. Now, as they outsourced more and more of this to Asia, to places like Taiwan, to places like Korea, Japan, these companies became unique in their expertise in actually developing some of this. So let me give you an example. To detect defects in the semiconductor manufacturing process, you need to detect defects that's almost 1/millionth of the size of the tip of your hair. It's close to the size of the human DNA. And there's only one company in the world that can do it, and that company is in Japan. Similarly, if you look at the different steps of the semiconductor manufacturing process, whether it is wafers, whether it is the manufacturing, the packaging, the assembly, there are only a handful of companies, usually one or two, that are actually able to do that today. And that's what makes the semiconductor supply chain in Asia really, really special, because guess what? It doesn't matter whether NVIDIA wins tomorrow, or whether AMD wins, or Facebook creates their own custom chip. They all have to use the same semiconductor supply chain, and that supply chain is in Asia. And even when people talk about reshoring, so the US, for example, wants to reshore. Guess who's creating the fab in the US? It's TSMC. It's an Asian company. Guess where the equipment's going to come from? It's going to come from Asia. So the point being that this part of the supply chain has become extremely critical for the world. It's unique in that there are very few companies that can do it, and the amount of know-how that's required in order to replicate this will take years. You can't just buy it with capital. You actually have to do it for many, many years and accumulate that knowledge. And that's what I find really, really interesting about the opportunities here in Asia. And everyone talks about the large companies today. So some of these companies are under the radar, and that's where we think there's exciting opportunity today.
So AI boom will continue to boost chip makers and drive tech growth. Now, you mentioned that there are opportunities in places like Taiwan, Japan, and even Korea. So what are the companies that can provide long-term opportunities, something that will turn out like NVIDIA?
So
Any suggestions so we can invest today?
Yeah, so there already are companies today that are within the NVIDIA supply chain. So for example, there's a company in Japan that does testing equipment for NVIDIA. They're the only ones who do it for NVIDIA. So as NVIDIA sells more boxes, they need more testing to be done, and there's only one company that can actually do it. If you think about the materials that go into creating some of these GPUs, so if I just back up for a moment, we talk a lot about AI, but what really is happening? What's happening is that there are a lot of companies buying a lot of these GPUs, which are called graphical processing units, and these GPUs are used to train models. And the current thinking is the more GPUs you have, the better your model becomes. So there is a gold rush for buying more and more GPUs, which is why NVIDIA is doing so well. But there is a process to making these GPUs. NVIDIA actually doesn't make them, they design them. The manufacturing of it is all done within Asia. And what's interesting is I had some colleagues who were in the US recently where they were talking to the heads of some of these big data centers, so Amazon, Facebook, and Microsoft. And all of these companies want to create an alternative to NVIDIA because they don't want only one supplier. So they're trying to create their own custom chips. But guess where those custom chips will be manufactured? Again, same supply chain. It has to all go there. So I think of them as the picks and shovels for the gold rush. They are the tools providers for the chip creation, which I think is going to continue. OpenAI thinks that they'll spend 40 to 50 billion, supposedly, to create the next model of ChatGPT. And if that's the trend that we're on, then there's still a lot of infrastructure that needs to be built out.
Let me ask you a little bit more. What about China? Because President Xi's slogan is high quality development and will prioritize sustainable growth for the tech sector, the high-tech industry. So will state support actually drive tech in China?
So I'll tell you how we think about this. So yes, state support is driving investment. Now, would you want to be a shareholder of a company that is subsidized by the state? The experience has been mixed there because you don't know when the state will sort of demand their capital back, and it might not be great for shareholders. But what we do know is there's a lot of spending happening. So one of the areas where a lot of these Chinese companies are buying from is actually Japan. From some of these semiconductor equipment companies in Japan, they are the ones who are selling to China, and these are all, there's sanctions today on what kind of equipment they can sell, and these are all sort of lagging edge, so they're older technology. But China doesn't have that technology, so they have to buy it, and we think that is a better way to get exposure to the spending in China than to invest directly within China, at least for the semiconductor space. In the other part of China tech, we do see some opportunities, as the previous panelists had discussed. We think we're early there, but on the semi side, we're seeing opportunity to play it outside of China, but still levered to that same capital that's being spent.
All right, now moving on to our next topic, some of the risks and concerns in the tech sector that investors should keep in mind at this point in time. Coming back to Kelvin.
Yeah, I think, there are two biggest risks that we should be aware of. I think one is cyclical risk. Cyclical meaning to say that, based on the demand and supply in terms of the production of chips and when it hit its peak and a sudden, lack of demand. I think this is something that we should be aware of. Let's not just chase the cycle for the sake of chasing. Right? And then secondly, I think regulations is coming in. I think, Europe has been the first government, right, or regulator to actually come up with an EU AI law. And I think this is a great initiative, to impose guardrails, right, on all these new technologies, right, to ensure that, all these AI generative things are properly accounted. No illegal content is actually being published. So I think that, these, awareness, right, for these, industries and these new upcoming technologies would have to be, have an oversight. So that would actually, cause, ongoing volatilities on new nascent technologies. But nevertheless, having said that, we still believe that the trajectory is still upwards, but it's not going to be on a straight line.
Christopher?
Yeah, there are a couple of risks on the horizon, and in a way, it's a good thing that we can discuss some risks here. So you really get an inflated market when there is no wall of worry to climb, right? So if there's something to discuss, it also means there is some more room for valuations to move. Of course, you be selective. So I'll discuss it from a couple of areas. So first, from a more macro standpoint, right? So if inflation stays stickier than expected, we may see interest rates stay higher for even longer, or we might even see a mini rate hike cycle. And that will have some implications on the tech sector. So first, valuations. So we clearly saw that in the year 2022, right? Aggressive rate hike cycle, we saw valuations compress in the tech sector. If that kind of happens, we might see that come to risk. Second, from a fundamental perspective, certain high growth companies, but still cash burning, they will and may struggle to do refinancing. And that again could create some fundamental issues. So that's one risk from a more macro perspective. Second, I think it's about investor crowding. So I alluded a lot about the Magnificent Seven, the 4 this year. Very well held names. AI, while we also agree with all the trends that is and will happen, a lot of investors' expectations have really been baked into some of these very obvious well-held names. So if you look at earnings expectations for the next few years, they have multiplied multifold, right? And this earnings expectations, in our mind, have not fully factored in competition, like he rightly pointed out, have not fully factored in or rising costs. Infrastructure demand doesn't go in a linear or a parabolic line. At some stage, infrastructure spending will taper. And in some of these names, the valuations or earnings expectations have baked in a really blue sky scenario. So there's a bit of risk here in some of these overcrowded names. And the third, I say again, a bit more macro in nature, a recession. So many of these tech names, they do rely on IT budgets, be it your CRM, customer relationship management, internal software upgrades. All of this will depend on IT budgets. In a recession, what goes first? Budgets, right? So this is a risk. Number of the big cap names, mega cap names like your Metas, Alphabet, etc., are reliant on advertising. So in a recessionary environment, what goes first as well? Marketing budgets. So these are some of the risks to think about, but at this point in time, we're not assigning a high probability, but still worth keeping an eye out on.
Yash?
Sure. So there are a few different risks that I think about. I think when we talk about AI, the data points that I'm looking for as a portfolio manager is, do we see applications of AI that are going to result in a return on the investment that all these companies are making? So just to step back, when people spend a lot of capital on NVIDIA GPUs, that's CapEx for them. That's an investment for them. They need to see a return on that investment. That return can come in the form of better advertisements. It can come in the form of co-pilot technology. It has to come from some mechanism where they see a multiple return on it, and therefore they can justify that investment. So I'm watching for data points to make sure that we are currently seeing those. I'll give you an example that was shared recently. One of the leading buy now, pay later companies in Europe basically saw a 30% increase in productivity of their call center just by implementing AI. Now remember, we're still in version 1. So that to me is a good data point. If you can increase productivity by 30%, that means that if you're thinking of hiring, you have 100 people, you're thinking of hiring 30 more people, those 30 more people will be AI. They won't be actual people. So there's an amount that you'd be willing to pay for that. But I think it's important for us to get that evidence that this investment is going to result in a return. And I would also say that the market can be very sensitive to this. If there is news out that some country is banning AI, or if there is news out that someone didn't get a good return, or they're going bankrupt, suddenly the market will react very quickly to that. And to me, that's the nature of a tech cycle. All tech cycles in the past, they've been choppy in their journey. So you should assume that even if you believe that the destination is here, the journey is going to be like this. And my view is that, okay, you should be focused on the end goal and decide whether the end goal still makes sense or not, but the journey is going to be volatile, and that's something we need to be prepared for. The other risk that I worry about is geopolitics. That is something that came up in the last panel, and that's something I worry about. Now, I would say that it isn't just a worry for Asia. I think that's a global risk. China, Taiwan, for example. We were meeting with some of the leading companies in the US last week, and they mentioned that people underestimate how important or how critical Asia is for the growth of the global economy. Which is to say that if something happens here, it's not just going to affect Asia, it's not just going to affect tech, it's going to have global implications. And I think there's an appreciation for that, but that's still something that I worry about a lot in terms of where is geopolitics heading.
Now, with the geopolitical tension that you mentioned, obviously US-China, the tech battle between these two nations, it will persist. And the question is, if it does, which area will it be evolving around? Artificial intelligence, or what areas do you think?
So I think artificial intelligence is something that most governments have realized it is a national security issue. So it's not just China and the US, but you will see many different countries. Italy just announced yesterday that they're going to do $1 billion fund for the development of AI. Singapore's made similar announcements. And everyone understands that they need to have investments in, as from a country security perspective, within artificial intelligence. Now, as far as the investment opportunity is concerned, I think some of the sanctions that the US has put on China is going to delay the progress that China can make. As I mentioned earlier, semiconductors is not just about throwing capital at the problem and you can get there. It takes a lot of time and know-how. It's like creating a recipe, creating the perfect dish. You can't just say that, I'm going to throw money at it and create the perfect dish. No, it's something that's refined over time. So semiconductors is very similar. So I do think that China is going to be at a disadvantage compared to the rest of the world who can access the latest technologies. But I would also say that its countries or companies in Asia are serving the global economy. They're not just serving Asia. So you're still part of the global supply chain, the global growth opportunity by being within the Asia context.
Kelvin, do you see the same complications when it comes to this issue?
Yeah, I think the China's framework is being restricted by the onset of the US coming down hard on them. But you can see that even despite that, you have seen what Huawei has done to their latest phone, developing their own AI chip. So I think that they don't need to be the market leading technological provider. They just need to cater to their domestic population. I think that's key. And secondly, right, these companies has to remain profitable, right? Earnings has to be positive, right? We don't need it to be the next most, nascent, revolutionary technology. The population is enough, right, to make companies profitable. So while there is, some, shortcomings, right, in this development in terms of geopolitical tensions, I think, China is still able to prosper and to grow in a very stable and contained fashion.
Coming to our next question now, the right time to enter into the tech sector. We see valuations. Some say they're overstretched. Some say they're undervalued. But definitely, you guys say that growth is still there to be seen. So, if investors are looking to invest in tech funds, what will be the way to find the entry, given that it's been trading at a pretty high price in the past couple of years? So please share your perspectives. Who wants to go first? Kelvin?
Maybe I'll take a shot first. I think, the sentiments of expensive overvaluation is really driven by the Magnificent Seven. So calendar year 2023, the M7 has delivered in totality about 76%, right? And S&P 500 has generated a total return of 26%. If you were to take away Magnificent Seven, the total return of S&P 500 x M7 is 13%, right? So clearly, M7 has a massive impact to the perception of the US stocks and also in terms of valuation. We do subscribe to the fact that it is unlikely that 2024 there's going to be a recession, right? It's more likely to be a soft landing, and we do believe that the proliferation of recovery will continue, and this recovery will broaden out beyond the Max 7. So the large caps, the mid caps, and the smaller caps, right, will benefit from this expansion of recovery, especially if the Fed is indeed going to cut rates in the second half of 2024. This was set as a positive macro backdrop for these companies. As we all know, technology companies or AI companies, they are long duration. Long duration meaning to say that they need sustainable earnings over a long term, and if rates were to cut, these kind of large caps companies will start to benefit due to the lower costs. So these will be certain opportunities broaden out beyond just tech. That could be a key idea for 2024.
Christopher?
Yeah, so I'm again going to answer this in a couple of ways. So first, I'll rely on a bit age-old wisdom, right? Timing the market is really a futile exercise. So missing the best 10 days of a market recovery means that over the long term, you could lose up to half the potential upside you could have if you stayed invested. Good example, 2022, right? When everyone was worried about recession, aggressive Fed, who knew the recovery from bottom till date? So that was about early October 2022. The rally has been really strong, right? In certain names, you have doubled 80%, etc. So time in the market is important. So I think that's one. Valuations, if you look at valuations where they are now, we are still a little bit below, meaningfully below actually, where we were the pre-Fed-led sell-off in 2021. I think that's the second point. And when looking at valuations as well, while looking at just pure valuation measures like PE, PB, does make a lot of sense. But if you do, again, adjust it for the potential earnings growth, so something we also look at from a PEG perspective, right? So you're looking about 30-odd times on the MSCI All Country World IT, NASDAQ not too far behind. We are expecting earnings to grow about 20% plus this year in the sector. So when you adjust this 30 times for this 20 plus times earnings, your PEG becomes a lot more moderate at 1 plus time. So again, that makes it a little less expensive as it optically may sound. And I totally agree with Kevin, right? So if we broaden our lens beyond the Mac 7, Mac 4, whatever you call it now, there are opportunities underneath the hood, right? many of which a bit less spoken about. So I spoke about how the recovery in the PC cycle, low-end handsets, that's one area. E-gaming, that's another cyclical recovery area we're looking at. Markets not really pricing this in. Structurally, a lot of stuff that's happening, like I mentioned, through the value chain of AI, beyond the obvious winners in semiconductors. There are names not reflecting the long-term outlook. So my whole point is, it's not overly expensive. You just need to pay attention, go beneath the obvious winners and see where the value is. So that really is how I will approach it.
Now, Yash, what's the expected growth of the Magnificent Seven versus the S&P 500 index this year? Will the earnings continue to outperform?
So I think if you look at the US companies, as this has been mentioned earlier, the growth is not just next year, it's over time. That's what everyone looks at. And that's been part of the reasons why they've been traded up, because the idea is that with AI, they'll all be able to leverage this to basically supercharge their businesses. And I think that's something, like, I think AI is going to be relevant for all companies, all industries. So it doesn't matter whether you're a manufacturing company, you're an auto company, you're a financial services firm. If you don't embrace technology, you'll be left behind. So that's something that I keep in mind, again, going back to what I mentioned earlier, that you have to think about where we're going in the long term. Valuation-wise, if I look at Asia especially, the spread between where Asia trades compared to the US, it has expanded. It's one of the highest it has been in the compared to the past. But compared to Asia's own history, it is higher than average. So valuation has gone up. But I would ask people to keep valuation in context of the ultimate earnings power of these companies, in that the growth profile of these companies has also changed. So some of that valuation re-rating is very much justified. But what I would, I think, echo, and this is a very boring answer on sort of your original question of market timing, which is don't time the market. The only consistent way that I know of to make money over time, especially in the tech sector, is to stay invested. Because remember, if there is a sell-off tomorrow of 10%, there's a reason why that sell-off happened. And then you might think it might go lower, and then it doesn't, and then people just keep waiting. And as you mentioned, you then miss some of the best days of the market. So, and additionally, when you're trying to time the market, you don't sleep well, because you're always trying to figure out what's going to happen. So you won't sleep well, plus you won't necessarily make good decisions. So my view is that make life simpler, stay invested. If you can, use drawdowns to top up your positions, and sleep well at night, knowing that this is the only strategy that has consistently worked over time.
Now, the market is going on the up and up, and some say it has to be corrected. So is it now ripe for correction? Is a correction coming up? Is that going to happen anytime soon?
Yeah,
Perhaps a good time for us to enter?
I think the prophecy of US going into a recession has been out for at least 2 years now, and it never happened. I mean, your guess is as good as mine. And we are not here to gamble or to bet on something. We are really here to look at the fundamentals, and we are glad that the central bankers in the US have done a great job containing the market, not overheating, neither is it cooling it substantially. So that has actually kept the market in check. And the global growth clearly looks at the US, right, to accelerate that recovery. And I think so far that has been a great trend. So in terms of recession, once again, I'm not sure the other speakers will agree, but we don't expect a recession in the US this year, right? And that will actually keep the macro backdrop globally quite positive.
Would you like to add on, Christopher?
Yeah, I would just say that volatility is a given, right? So we will experience volatility, make no doubt about that. So if you believe in the long-term trend of tech, I think any volatility would be a good point to continue kind of averaging into positions. I think that's one. And valuations, again, in the short, medium term, isn't a very good barometer to time markets, right? Markets can stay overbought for a while, longer, can stay a little bit elevated to cycle averages for longer. So it's also a bit of futile exercise to solely look at valuation and say, I'm going to time wait for it to come down. So really, my message here is to stay invested, buy on dips, and more importantly, pick your spots. And I think that's why all of us believe in active management. It is looking underneath the hood, picking the right names within a very broad and non-homogeneous tech sector.
I'll just share a joke that economists have predicted 15 of the last 2 recessions. So it's very hard to call a recession if you base your investing based on, when to time the market. You actually end up doing, there are studies that have shown that you end up doing worse than what the market does.
All right, well, that was a closer look at the tech sector, and it shall be substantially influenced by the advancements of AI. There are still opportunities, but risks as well. So you have to stay abreast of the information, stay updated, stay invested to make well-informed decisions. So we've come to the end of this session. A big round of applause, please, thanking our speakers. A big hand for Mr. Kelvin Lam from Allianz Global Investors, Mr. Christopher Wong from Fidelity International, and Mr. Yash Patodia from Wellington Management. So, gentlemen, thank you so much.